Andrew, you're next.
First of all, I'd like to thank Rob Johnson and George Soros for inviting me to this historic place in front of all the people I respect here, talking about some very, very important topic that I've spent quite a lot of time on this subject. And first of all, I think my title, Too Big to Fail, Too Big to Jail, is not a morality statement. It's actually a physical question, because how do you regulate or even jail an institution that is 5 times to 10 times larger than a single nation, or even, and even probably, global GDP. But I'm in a slightly jet-lag mode, and last night I was visited by 3 ghosts of Bretton Woods. And the first one whispered to me, ruthless truth-telling. And that, of course, was Maynard Keynes. Maybe it was my imagination, but that's what he told the IMF to do when he at the opening of IMF. But my second ghost was Asian, and he said, ruthless truth-telling, you have to apologize. Most Asians apologize for lots of things, like saving too much, being a regulator all my life, didn't regulate enough. But I just want to say that all the views that I state here are personal, and of course nothing to associate with any official institution that I'm dealing with, same as Claudio Borio. And the third ghost basically happened to be like a godfather type, and he said, never mind any opinion you give, it ain't personal, it's business. So I'm going to try and switch this off. I'm going to try, very quickly to go into some of the key issues. Now, you will see that I'm a disciple of Minsky, but I think Minsky plus Soros plus a historical view is essentially what we're dealing with. The system is unstable, but I think we have not taken a historical view that we have a systemic problem of no hard budget constraint, and that issue will come up very clearly later. Now, Minsky was the first one to realize that the problem is a systemic one. This is a systemic problem that if we don't have and we've been dealing with it academically on a partial basis and bureaucratically on a silo basis, so that the silos are not looking at the problem as a whole, and bureaucratically it's another bureau's problem, and nationally it's a global problem, and that's an issue that we can't deal with. So if you really look at the whole systemic issue, first of all, it's structural, then it's macro, then it's micro, the question of who does the loss allocation, and then you have to look at it from a historical perspective also. Now, the crisis starts from excess consumption caused by excess leverage. And the issue about G-SIFIs, our large complex financial institutions, is that they are the channels of that leverage. They're not necessarily the cause. The fundamental cause is the fact that we have too much consumption, but the G-SIFIs are the channels of that leverage. And I want to explain this later, because we're facing twin crises of fiat money with no hard budget constraint and global warming, which is caused by excess consumption of natural resources financed through large leverage. Now, the problem is the financial engineering is a Ponzi scheme, as all of you know, and with the momentum play, the more the system, financial engineering, give the leverage, the lower the interest rate. The lower the interest rate, the higher the asset bubble, because lower interest rates is reflected in the size of the bubble. And you add this with the accounting standard, which measures the asset and then puts the liability below the line. And then on the incentive scheme, you take 50% of the profits of the financial institution off the table for the remuneration. Hallelujah, you've got a big problem, but the bubble is always saved by the central bank, because and until you reach zero interest rates, you save them and you start all over again. So the mainstream economics on a flow basis has ignored the balance sheet ignored the dynamism, and created this elusive things are all about liquidity when the fundamental problem is the solvency crisis, and we're still dealing with it. So I think this chart basically shows what Adair Turner has demonstrated for several times. But the real problem is that too big to fail really creates a capture problem. And this capture problem is a political economy question, which, because they are now larger than single nations, the top 25 banks comprise 73% of global GDP, excluding the derivative side of which are not yet measured, and 45% of the total assets of the banking system, according to IMF data. So when they are so powerful, they essentially Godzillas, because Godzilla was created, as you know, by excess radiation, and G-SIFIs are network effects. And network effects, have what you call concentration effects of winner take all, so that all network markets like credit cards, airlines, networks like Google, there are 3 or 4 essentially are the big winners globally. Now, the problem is that so far banks have been regulated nationally, and we've allowed the real sector side to concentrate. But the Godzillas have gone outside the border, so it's not just national in life, but global in life, national in death. The problem really is it's a global game and it's a national blame. The problem is that we blame the politicians for not regulating these G-SIFIs, but we blame it at a national level because you can't blame this. Now, the whole problem is actually information asymmetry, power asymmetry, and the reflexive leverage momentum trading. Because the information asymmetry is that fragmented systems can't see the problem, nobody sees it, and everybody escapes through the regulatory net by moving offshore. The power asymmetry is the principal agent problem. Traditionally, finance has always been agents. But the minute you have proprietary trading, and proprietary trading with state guarantee, they can grow through the Metcalfe's law, the network effect, bigger than nations, they capture nations and nobody can control them. So it's a political problem. But the worst part is the third part, which Soros has put. If you're reflexive leverage momentum trading, you actually influence the interest rate, and the interest rate influences the bubble, and then the management take the money off the table, and you're in deep trouble. So the information asymmetry you know about, systemic risk you know about, I don't need to talk, unknown, to talk about. But the power asymmetry is really a serious one. Regulators who are underpaid, don't have the same knowledge, can't deal with these problems. But the problem has been, they say, well, you don't understand this. Yesterday, Larry put it very well. Most people don't understand what financial engineering is all about. So you put the guys in charge of financial engineering in charge of the financial industry. But we all know, from those of you 101 MBA, management that is part of the problem cannot be part of the solution. And that, is the power asymmetry that we have to capture. I recommend you read all this, and Simon is the expert, so I'm not going to go, into this area. The externalities we've known about, the leverage problem we talked about. I am not totally convinced that supervisory colleges can solve that problem out. Garry Schinasi has talked about already. The real problem now is that there's a shift in the loss allocation through highly leveraged capital flows. And emerging market central banks who have no leverage foreign exchange have very great difficulty dealing with this momentum wall of money. Individually, they have a collective action trap. You can't raise interest rates, you can't raise exchange rate without inviting a ton of leverage, short-term money that creates that bubble. And so it becomes a global private gain, a national public loss pain problem. And so, but the lesson from this crisis is that the crisis has created lower and lower interest rates, large asset bubbles, and transferred the losses of that bubble deflation onto the public sector balance sheet. And that's due to the fundamental problem of guarantee. So the real issue is that this is not a regulatory problem. You can't fix it on a regulatory basis. It's a major political problem. Because if we were to have a completely free market economy, there would be only 4 or 5 large financial Godzillas that are bigger than the global GDP itself, and nobody is big enough to be able to control it, except that you need to sort this out. And I believe that's why Roosevelt sorted it out, because he saw this was a political problem. Now, what are the possible remedies in this? And my issue is that actually, you think about it, excess consumption has to be sorted out through excess taxation, because you can't solve a debt crisis with more debt. And that real fundamental problem is why I think the turnover tax and the tax on consumption has to be solved. Because if we don't solve the excess consumption, if we ask every emerging market, the 2 billion, in fact, the 5 billion of emerging markets, to consume exactly the advanced market people per capita, there will be no natural resources left. And so what is really happening is that you're printing fiat money, but the hard budget constraint is not there. And the real issue is that for a stable system, Minsky saw this very clearly. Fiat money must agree with the real bills doctrine. If the money supply through fiat money does not grow faster than the real GDP, then there will be no inflation, then there will be stable money. But if you continue having this fiat money being printed by the shadow banking system, and the shadow banking system has $20 trillion in 2007, not measured in any monetary survey, not measured in any regulatory systemic coverage, guess what? The Godzillas are having a free lunch printing fiat money with no global body to control them. And national bodies are just simply too small to get a grip on them because they are bigger than nations. And so, we have this fundamental political economy question which we haven't been able to solve. Now, the issue then comes down to a public-private check and balance issue. Adam Smith assumed that private greed was checked by public sector for public good. That's 4. But in reality, if the bureaucratic has a self-interest and work together with the private sector on a capture basis, then the system flows only one way, and that's why you're getting massive, huge sort of inequalities that are going on the income and the wealth side. And the idea of the free market is a myth, because if 5 largest Godzillas control 2/3 of trading and maybe 100% of the CDS market, is that a free market? If I, Andrew Sheng, trade against one of these Godzillas, if I fail, I die, nobody sheds a tear on it, but he not only sees my trade, because he's an accumulator of trade flows, if he loses, he will be bailed out by the state and probably with my tax money. Now, where is the level playing field? It's no longer a level playing field. And that is a serious political economy question that we need to deal with. So what is the countervailing power to capture problem is the real issue. So to sum up, the natural network effects of concentration in global financial markets, under fragmented national supervision with information asymmetry, creates a collective action trap both at the national and the global level. Now, this pro-cyclical momentum playing by the Godzivis have currently no hard budget constraint. And until we devise that through a combination of taxation and a political economy issue, you have no sand in the wheels. Zero interest rate and quantitative money tries to solve an excess debt problem with more debt, and I don't think that will go anywhere. So the real issue is that the world's prices are now totally distorted. The price of capital is now basically zero. The price of wages, labor is very low because of the entry of a very large emerging market capital. And then the resources are shrinking. Therefore, are you surprised that commodity prices are now shooting through the roof? But the real fundamental problem is the inequality problem. And until we have monetary and fiscal regulatory discipline in global fiat money, we won't solve this problem. On that note, I apologize for all this very rude talking, and thank you very much for your patience in listening.
Well, thank you very much. Thank you, Andrew.